Hello, everybody. Thank you. Thank you, everybody, for coming. And welcome to Financial Triage, where we talk about all things financial planning and how it impacts your finances. Today's presentation is sponsored by Milestone Financial Planning, and today's topic is, are you ready to retire? We'll make sure you're doing it right. Many of you know me, but for those of you who don't, my name is Jennifer Climo. I have been providing income tax advice to individuals and small businesses for over 30 years, and I've been providing financial planning and investment advice to individuals and families for over 20 years. I'm a certified public accountant and a certified financial planner. I am the CEO and senior advisor for Milestone Financial Planning, located across the street from here in Executive Park. You can connect with me on LinkedIn or on X using my name, and the links are in the slides. There's a lot of material for us to get through, so we're going to be moving fairly quickly. My team and I will be available for questions at the end or after the presentation, and you can also reach out to our team at info@milestonefinancialplanning.com or through our website, milestonefinancialplanning.com. Do not make financial decisions based on this or any other financial seminar. Everybody's circumstances are different, and so you want to make sure that you talk to a qualified financial advisor regarding your specific circumstances before you make decisions. Almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results, and nothing you hear today should be considered investment advice. A reminder, we are being filmed for future posting on YouTube, so please be aware of that if you ask questions, but please don't let that deter you. You can download the slides if you want to by hovering over the QR code that will be on the slides periodically and pressing the link that then appears, and our planning associates in the audience are available to help you if you need that. Evan, Catherine, and Garrett. Thank you. Are you ready to retire? Retirement is a time when you are moving from performing activities that earn income to those that have more meaning. Even if you're confident that you have enough financial resources to retire, you might still have questions, such as, where is your income going to come from that you're going to use to pay for your expenses? There's many different sources of retirement income, but we're going to start by talking about portfolio distributions. These include all of your accounts, your taxable brokerage accounts, trust accounts, IRAs, Roth IRAs, 401ks, etc. We're going to get into the specifics of those accounts later, but for right now, we're talking about your entire portfolio of all of your investments. And we're not talking about necessarily the income off those investments. And many, many years ago, everybody used to think, oh, I'm going to live off the income and save the principal. It's not that way anymore. We want you to think about your investments as a bucket. And the bucket has water, which is the cash that fuels your spending. It has rain, bonds, rain income into the water. And then there's snow, which is stocks. Snow is a little bit harder to turn into water, but it still can be done fairly easily. So all of that, when you're taking water out of the bucket, it doesn't matter if it's rain or snow or water, it's all still liquid. It's all going to be the same. That's how I want you to think about your investments. Doesn't matter what the interest or the dividends or the capital gains were. We're looking at total return, which also includes the increase in value of the investments. How much can you withdraw from your portfolio? This is the question everybody wants to know. Back in the 1980s, there was a financial advisor of the name Bill Bengen. And Bill did all of this research using a 60% stock, 40% bond portfolio. And what he wanted to determine is how can I find a safe withdrawal rate? And his definition of safe withdrawal rate, after he looked at all of these different scenarios, he came up with 4%. So you may have heard of the 4% rule, especially if you've been Googling and looking things online. This is where it comes from, Bill Bengen. So he back tested it back with actual real returns going back to the 50s, 30 years from when he started in the 80s. And it seemed to work in most scenarios. Most retirement portfolios were able to last with a 60-40 portfolio, only taking out 4% of the beginning balance, and then increasing that amount, that 4% dollar amount, would go up by inflation in every subsequent year. And he looked at whatever CPI was, and he increased that by CPI. And then that's how people got their distribution. So you have an ever rising stream of income, which is so, so important because, as we all know, the cost of living goes up and up and up. So whether or not that will last forever is anybody's guess, but forevermore, since the 80s, financial advisors have been thinking about this 4% rule and using this as a baseline. And while past performance never predicts future results, it's worked pretty well. And in fact, in practice, some of us use different, there's reasons where you can take out a little bit more than 4%. You don't have to limit it to 4% necessarily, as long as you make other adjustments. And in later papers, he identified this, and he wrote that if you put in additional protections, for example, you don't increase your distributions by inflation each year. And here's a fun fact. I don't have any clients that come to me on January 1st and say, please increase my distributions by CPI 1.043. Nobody does that. Okay? What they do is they say, hey, you're sending me $5,200 a month and our expenses have gone up. Can you send me $5,500? Sure. But oftentimes, that doesn't happen for years. We send the people the same amount every year for forever, and some of them are even saving and adding to their accounts with it. It's just that this is real life. So real life isn't all these numbers. But it's interesting to know, so this is a conservative portraying how to take out money, because this is what he did. Is the theory is you can take out, increase whatever you're taking out by inflation every single year. Additional protections also include retiring with more than you think you need, which is something we're going to talk about in a little bit. Okay, here's an actual example, the fun stuff. Let's say you have a $2 million portfolio, and remember, this is only one of your retirement income sources. There will be others potentially. So of this, 4% of $2 million is $80,000 a year, about $6,700 a month. Your total income, whether it's your portfolio distributions or your portfolio distributions plus pension plus Social Security plus whatever else there is, your total income needs to cover all of your expenses, including your income taxes, your real estate taxes, your long-term care premiums, your auto repairs, your vacations. If you're going back and taking out extra lump sums for these extra expenses, then those need to be added in to the total distribution amount to calculate your withdrawal rate. Your withdrawal rate is based on everything you take out of the portfolio during the year divided by your portfolio beginning balance. And that's what you want to target 4%, according to Bill Bengen. Different in real life, but this is the math. Here's another example. Let's say, for easy math, we're going to use $1 million. You have a $1 million portfolio. Let's pretend dividends and interest were $20,000. Today, that would be a little bit higher with interest rates up, but we're just going to go with this for easy math. Say it grows 5%. So now you've got $1,070,000, and you take out 4% of that, $42,800. Your beginning balance for year 2 is the $1,070,000 minus the $42,800 is $1,027,200. Next year's distributions are the $42,800 increased by, we're going to pretend inflation is 3% because that's the long-term historical average. So we're going to increase that $42,800 by 3%, and the following year distributions will be $44,084. Important to remember, only in the first year do you use the 4% number. That's the only year that's relevant in this, in Bill Bengen's research. Every other year it's dependent on inflation. But in reality, as I explained, that's not how people take out money, which is actually better. This is conservative planning. Now let's say, what happens if instead of your portfolio going up, it goes down, which does and will happen. So say your $1 million falls by 10%. You have the same $20,000 dividends and interest. Market falls 10%. That's $100,000. Your ending balance is only $920,000 times 4%, $36,800. Your beginning balance year 2, $920,000 minus $36,800 is $883,200. Your future year distributions is the 36.8 times 1.03, or 37,904. So that is a substantial decrease in income, you will note. That is a monthly income of about $3,066 a month versus $3,566. So that's a $500 difference. So substantial if things go up and things go down. And remind you, you don't control what's going to happen to the markets. No one does. So it's hard to know what's going to happen. So what is the answer to this conundrum? Because you don't want that to happen. Now let's pretend your budget needs $3,500 a month. And so you were happy in the first scenario because you got your $3,500 a month. But in the second scenario, that's a real bummer because you can only take $3,000 and that's not enough to pay for your expenses. Well, the answer to this, you might think, oh, I just need a more conservative asset allocation so the portfolio doesn't fall. And that is actually not the answer. The answer really is to retire with more than you need so that the lower amount is completely irrelevant. For example, if you had 1.5 million instead of 1 million, your interest and dividends would be about 30,000, let's just say. And if it fell 10%, then now you're down to 1,380,000 times 4% is 55,200. And 55,200 is $4,600 a month, way more than the 3,500 you need. Make the market movements irrelevant. Retire with more than you need. So just to cover the wiggliness of the stock market, that's my technical term for volatility, which is, volatility is a word that you might read about, but it's the ups and the downs, right? And so this is a slide that shows you all of the bear and bull markets since 1920, from 1922 to 2022, essentially. And you can see that the ups are way more than the downs. And this is traditionally, even though when we have downs, they are terrifying, right? So who remembers, let's see, I don't really remember the 70s, I was too young, but that was, I'm sure, bad. 2001, though, I remember starting my financial planning classes at Bentley for my master's degree in 2001, the day after the towers came down. And we were all like talking to the professor, what do you do? Like, what do you tell clients? How does this work? I remember that vividly. It's very interesting. So, and as you can see, that was a blip. That's on here, but a blip in the scheme of things. The financial crisis is, of course, on here in 2006. I don't know if you guys can see this tiny little, so right here, that's the financial crisis. And then here's COVID, and then 2022. Last year was pretty bad. You guys, I don't know if any of you remember that with your portfolios. They were down kind of, right? I mean, the markets were not kind from 2022. Of course, I don't have 23 on the slides, unfortunately. But so when you're in them, they're scary. But the important thing to remember is that they end. And the reason we have these big ups is because we have the downs. Without the downs, we would not have the ups, and more money is made by holding stocks. That's where the wealth is built, is by having stocks. And so a lot of the theme of this, if there was such a theme, is do not be afraid of the stock market. Stocks are how you build wealth. And history shows that the negative volatility has always been temporary. Will it always be? Who knows? But it always has been temporary on the permanent upward march of stocks. And you never want to sell out when you're in one of those red periods. That was bad. That's almost impossible to recover from. And I have talked many clients off the ledge of wanting to sell out during down markets. And there are some that didn't listen and wish they did. Because I can't fix that. There's no fixing that if you actually sell out during a down market. Also, I have to say that past performance does not predict future performance, and don't consider this investment advice. And that is index performance, which you can't actually invest in an index that doesn't have fees, right? So caveat, caveat, caveat. The most dangerous 4 words in investing. This time is different. This time is never different. If you're over 40, some of you are over 40. Let's see if you remember any of these. The internet will change the rules of investing. Y2K. Terrorist attacks have changed the rules of investing forever. 2001. The financial crisis have changed the rules of investing. 2009. The pandemic has changed everything, including the rules of investing. 2020. My favorite, the 1979 Business Week magazine cover. I was only 10, I don't actually remember this, but the death of equities. Equities were done in 1979. Some of you may remember this, it's very famous. On the 30-year anniversary of this, Business Week, I guess, got bought out and folded into Bloomberg. And Bloomberg put out an article in 2019 commemorating this and says, we've been lambasted for this over the years. Everyone has hounded on this. Since this article came out, the S&P 500, according to the article in 2019, grew over 7,000%. It was not the death of equities, needless to say. You just had to wait 3 years for the market to bottom. But when you're in the market, when it's down like that, and then 3 years are going by, and every day, there's more social media and the TV, and everyone's talking about it, it can be very anxiety-provoking. So it is actually difficult from behavior's perspective to stay invested, but staying invested is what you must do. And your portfolio should absolutely be able to withstand the three years until the market bottomed, even in retirement. When people say to me, Bo, I don't have that long, I'm retiring, I only have a few years. Well, no, you have 20 to 30 years. That's a long-term time horizon. And yes, 3 years should be just a blip. This time is not different. The rules of investing remain the same. Stock prices are based on the future cash flows of underlying businesses, real businesses that make real things. And businesses pivot when crisis strikes. So during certain types of crisis, companies that make, let's say, toilet paper thrive, or DocuSign thrived, right? Zoom went nuts during the pandemic. And the restaurants that could pivot to outdoor seating did well. Those that were unable to pivot died, which is awful and sad, but that's what happens. The horse and buggies are no longer, but cars are a thing. As time goes on, some businesses thrive and some do not. And therefore, owning everything, you're more likely to keep up with everything and own it all and reduce your individual stock risk. So new businesses spring up, own everything, stay invested. Current events should not influence your investment strategy. That's a big lesson here. Repeat that. Current events should have nothing to do with your investment strategy. Volatility is the reason U.S. stocks have an average annual return of 10% over 96 years. And it's pretty much been 10% my entire career. The long-term 20, 30, 50, however many years average hasn't really varied all that much. It's never exactly 10%, but it's up and down over time. So you'll remember, your portfolio does not pretty much ever go up exactly 10%. It goes up 30, it goes down 10, it goes up 22, it goes down 17. It's all over the place. It's the average that's 10, but you have wild swings. And the average inter-year swing during any calendar year is 14%, meaning from the low to the high in the year. On average, since World War II, it's been 14%. We just don't pay attention or remember all of these all year long. We just remember the ones that are talked about, like the financial crisis, 2020, 2022, et cetera. What about the election? Don't I need to worry about who's going to be president? No, doesn't matter. Now, this slide might be kind of small, but he's got all these presidents on it since Hoover. Before the banking laws, things were not good. But we've had banking laws since, and this is the cumulative returns of all the presidential terms. And it does not matter who is president. And the top one with Biden, this only goes through 2022, which is, I mentioned before, was a bad year. 2023 has been a great year. When we tack that on, and next year, when that slide is updated, I expect the Biden to look similar to some of these other lines. It really doesn't matter who's president. Don't worry about it. Don't panic. And definitely don't sell out because the candidate you hate wins. Do you ever call your advisor and ask them if they should consider selling out one of the asset classes that you own, one of the funds? This fund hasn't done anything. I really think we should get rid of it. Can't they predict which asset class is going to outperform? No, neither can you. Nobody can. Even talking heads that think they can. Whenever I read something on the financial news that says analysts are predicting I skip it. I go to the next thing because it does not matter what analysts are predicting because none of them are going to be right. Nobody knows how to predict anything, and it's pointless to try to listen to all that. You'll just drive yourself crazy. Now, I'm going to point out a couple things on this slide, which you can't see because the numbers are tiny, and especially using the back, probably really can't see. But this is 2008 through 2022. Each of these colors is a specific asset class. I want you to think of your investments as buckets, a series of buckets. Each bucket is one asset class. So your portfolio consists of all of these in different percentages, all of these colors. And I can't tell you how many of these times whatever did the worst in one year did the best the next year. So we're going to take the very first column, which is emerging markets in 2008, in the depths of the financial crisis, was down 53.2%. That's pretty bad for that bucket. But the next year, if you had sold out, you would have missed. The next year it was up 79%. So again, this is why you don't dump out of asset classes. A, nobody knows what they're going to do in the next year. And B, you don't know when it's going to turn around. This yellowy color here is international small cap. It was the worst performer in 2014, but the best in 2015. Another example is REITs. REITs are real estate investment trusts. I'll go over here for you guys so you can see what I'm pointing to. Real estate investment trusts here in 2020 were down 11% at the absolute bottom, but they were up 45% in 2021. So again, you cannot predict which asset class is going to do best, and neither can your brother or your friend's advisor or any talking head on TV. Nobody knows. Despite everybody thinking they know and trying to tell you that they know, they don't. Own it all. Focus on the variables within your financial planning that you can control, not which asset class is going to perform. Now we're going to move on to another income source called rental property. Now many of you, or I don't know if any of you actually own rental property. Rental property is, rental income is based on your income minus your expenses, whatever it takes to run the property, and what is left over. If you're going to own rental property and have rental income, you will need a significant amount of capital to fund the ongoing expenses. As many of you know, probably most of you own houses. Things break. You need a new roof, you need a new septic, you need a new driveway, you need a new boiler. All of that is usually tens of thousands of dollars, very expensive. So rental income is not for the faint of heart and is generally not for folks that don't have capital unless they have significant construction abilities. We do like rental income in that if it generates losses, here's the question. Are the losses tax deductible? Don't know. Are they? You might think they are. Well, guess what? If your income is more than $75,000 if you're single, or $150,000 if you're married filing joint, you cannot deduct those losses in that year. Now, you don't lose them. They carry over to a future year. But they are not, people might think, oh, I'll take the depreciation, I get to write it off, it's going to be great. You're high income, you can't do that. So that's frequently misunderstood. Losses do carry forward, and when you sell a property, and we'll talk about later, tell a little quick story. I had a client that had rental real estate. They had it for many years, so they had the capital. They'd replaced everything. It was great. It was just a cash flow, and they were depreciating it, so they had on-paper losses. They had paper losses, but they didn't get to deduct them many years because their income was too high. Well, then they sold the property, and the great news, when you sell a piece of real estate, you get to deduct all of the accumulated passive losses. They're called passive losses that have accumulated. They had a huge loss, very little income. Their tax return, they would have ended up with zero tax on their tax return. Doesn't that sound awesome? No tax whatsoever. However, I said, you have an IRA. If you have an IRA, you have no business having zero tax on your tax return because you can just say, we moved that IRA over $100,000 into her Roth IRA. We'll talk about Roths in a bit, which grew tax-free for their entire lifetime at a 10% tax cost. If we hadn't done that, that loss would have been wasted. They would have saved no tax. They would have paid no tax, but they wouldn't have offset any income with it. And someday she would have been taxed on that IRA at whatever tax rate she was in at the time that came out, probably a much higher rate. There's moves like that during retirement that can save you a boatload of taxes. Now we're going to talk about retirement accounts. IRAs, 401ks, 403Bs, TSPs, we'll throw 457s, alphabet soup, all these numbers and letters. What does it all mean? If you have one of these, you probably know what they mean. When you originally saved in these accounts, you promised the government that you would eventually pay taxes on this money and the money that it accumulated. That time is now when you're taking distributions. Now it's going to be taxable. You spend your entire life accumulating, and then I like to say, well, you're going to spend all the rest of your retirement trying to get the money out. So as people start moving towards retirement, and we're planning retirements, we tell people that, okay, let's stop contributing unless you're in a very high tax bracket. Maybe you want to stop contributing or contribute to the Roth portion, because we're going to be moving money out of this over the rest of your lifetime to reduce lifetime taxes. Because the name of the game is you don't want to reduce your taxes in any one specific year. You want to reduce your lifetime taxes. And so sometimes that requires making choices where you pay more in taxes this year. It's all about being tax efficient. Now, moving on to required minimum distributions. All of those accounts I mentioned, once you reach a certain age, you are required to withdraw from them. You are required to be taxed on them. You are not required to spend the money. You are not required to sell the investments. If you were born in the 1950s, your retirement age is 73, your required minimum distribution age. If you were born in 1960 or later, your required minimum distribution age is 75. The RMD is due by April 1st of the year you turn that age. Every other year, you have to take it out before the end of the year, before December 31st. For that reason, we recommend that you take it out the year you turn 73 or 75. Don't wait till April 1st of the next year, or you're going to be taxed on two of them in 1 year. And depending on your income, I mean, that might make sense based on your income and whatever else is going on, but it probably won't, and it could bump you into a higher tax bracket. So you want to be careful of that. You also don't want to wait and not touch your IRAs until 75 for those of us born after 1960, or that could be a little bit painful from a tax perspective. These RMDs are taxed you at ordinary tax rates, and you can use them to pay your taxes. You can, in fact, not pay any taxes all year, take your entire RMD, withhold all of it for taxes, and pay your whole tax bill on December 31st. That is a strategy. I wouldn't recommend that. That would stress me out. But you could do that. In fact, we do that. If you're a client, you probably know this, that when we take your RMD, we withhold taxes on it. Before we withhold taxes, somebody, often Evan here, prepares a tax projection showing how much exactly we should withhold to cover the entire taxes that person owes for the year. So that's a great strategy. You definitely want to plan for removing these amounts from your retirement accounts over your lifetime to smooth taxation, and again, reduce your future forced taxation in the name of RMDs. And the reason you don't want to let your IRA build and build and build till age 75 and take nothing out, and now you're going to start taking it out, is because now you will have a giant tax bomb. Because how are you going to empty that now? Now you're over 75, so you're collecting Social Security, you've got investment income that continued to rise, you have other income. Ouch. Medicare premiums will be higher. You can also take your RMDs from your IRAs. If you have multiple IRAs, you can take all your RMDs from one of the accounts. If you have a 403B, you have multiple 403Bs, which hopefully you don't consolidate those. But if you do, multiple 403Bs, you can take all your RMDs from one account. But if you have 401Ks, why does the government do this? I don't know. You have to do it for each account has its own RMD in the 401K. Now, hopefully, once you retire, you roll all those accounts into your IRA. It's consolidated. You don't have those issues, but if not, those are the rules. Also, if you're still working and you don't own more than 5% of the business you're working in, you can delay your RMD until you retire. But if you own more than 5%, too bad for you. You can't. I love taxable accounts. I find these accounts underutilized. Everyone's like, well, we got to put money in our Roth and our 401K, and then that's it. I've done the maximum, so I'm done saving. Well, no. Your taxable account just means the earnings are taxable, but they're taxable at low tax rates, much lower than pretty much any other income. Have unlimited contributions. They have no withdrawal restrictions. They can be used for any purpose without penalty. The distributions are only partially taxed, and what is taxed at low rates, and you get a step-up in basis at death so that your heirs will never pay taxes on those gains. That sounds pretty good to me. The strategy here in your taxable account is to minimize the ordinary income. So you want it all taxed as qualified dividends or capital gains, long-term capital gains. You don't want to be day trading in your taxable account. You don't want to be incurring ordinary income. You don't want to have too many bonds in your taxable accounts that are throwing off ordinary income, because the interest from bonds, even though they call it dividends on the statements, it's taxed at ordinary tax rates. And you don't want to own, in generalization, might not want to own real estate investment trusts in your taxable account, because that will throw off ordinary income. Now, there are reasons to. There's sometimes other reasons to own them today. But in general, if you're looking to minimize your tax rate and minimize your ordinary income in your taxable accounts, that's how you do it. What about Roth IRA distributions? Many of you, especially if you're a Milestone client, probably know all about Roth IRAs. Roth IRAs grow tax-free. There's no tax deduction for putting the money in, but it grows tax-free as long as you and your spouse are alive, and whoever inherits it gets to have it tax-free for 10 years thereafter, but then they have to take it out. While you're alive and you contributing to this Roth IRA, if you're over 59 and a half, you can take money out tax-free anytime you want. Doesn't matter. Account doesn't have to be open any length of time. But if you're under 59 and a half, the account must be open for 5 years before you can take out any money tax-free, or it won't be tax-free. Also, if you've done a Roth conversion and you're under age 59 and a half and you want to take some money out, you can't do that either until that 5 years has passed from that specific Roth conversion. So if you do Roth conversions every year, each one has their own clock. And if you're over 59 and a half, that doesn't apply to you, because you can do whatever you want. You're special, 59 and a half. If you have kids, adult children, many of you have adult children that are working now, tell them to contribute to their Roth 401ks. They are probably in the lowest tax bracket of their entire life. It makes no sense to put money into a regular 401k at age 22 or 23 when you're in the 12% tax bracket, and take it out years later when you're in the, who knows what tax brackets will be then, but today it would be 32, 35%. That just doesn't make sense to do that. So low tax brackets, contribute to your Roth 401k. High tax bracket, contribute to your regular 401k. If you're still working, your specific situation dictates what is the right move for you, and it very highly depends on your specific tax situation and other factors. But as a generalization, that's the generalization. Tell your kids to contribute to their Roths now. A great gift too, by the way, if you have money for gifting. We're not covering gifting today, but if you are gifting to your kids, a great strategy is to contribute to their Roth IRA, assuming they're under the income limits and are eligible to do one. It's a great way to set up your adult children for success. My favorite topic, annuities. Ann knows me. How many of you were ever sold an annuity? No one's going to raise their hand. Sorry. It's supposed to be interactive. Okay. And I say sold because people do not go and buy annuities. In general, they don't go and say, hey, you know what? I really want an annuity. What happens is somebody comes up to them after, say we're in the financial crisis, right? And everything's tanked, and your portfolios were down 35%. It was awful. And an insurance agent comes up to you and says, boy, stock market is terrible, isn't it? What if I could guarantee you some income? Wow, that sounds pretty good. Guaranteed income. No losses. I like that. Right. Problem is, they're preying on your fear of the stock market. So I'm going to go back to, remember, owning stocks is what builds wealth. Always remember that. Stocks build wealth. So avoiding stocks, not building wealth. Annuities will not build you wealth. There is something called a SPIA, single premium immediate annuity. What that means is, let's say you have $500,000. You give $500,000 to the insurance company, and they will promise to pay you an amount for the rest of your life every month. Call it $2,800 for the sake of argument. And the actual amount depends on many factors, including interest rates at the time that you buy it. So say you're getting $2,800 a month, but you have to give them the $500,000. The $500,000, when you immediately annuitize it, which is a single premium immediate annuity, means it's immediately annuitized, which means they're giving you the monthly payment. $500,000, poof, it's gone. You can't withdraw from it anymore, and the $2,800 never goes up, ever. That's the SPIA. Your biggest risk in retirement is not the fluctuations in your investment portfolio. It is the rising cost of living. Does anyone here know what the price of a postage stamp was in 30 years ago, which, believe it or not, was 1994? I'm having trouble understanding that. 1994, 30 years ago. Anyone want to guess? Where's 22? What do we got over here? Someone said 25? 23? 25? Where is Garrett Lambert? Do you remember what the answer is? 29 cents. So you guys are all very close. It's 29 cents. Today, a postage stamp is 73 cents. So stamps are a really good proxy of inflation. They're really good to use. So that is, if you do the math and you divide 73 by 29, it's 2.5 times. So you can expect in your retirement lifetime that your expenses are going to go up 2.5 times. So $2,800 a month sounds awesome now. 30 years from now, not so much. I do taxes, so I see people's pensions, because pensions are also annuities, and you see somebody with an annual pension of $900, which I'm sure sounded like a lot of money when they retired 40 years ago, but it just isn't anymore. Annuities sound great. They are not necessarily great for your finances. So remember back in our previous example when we said you needed $3,500 a month to make from your portfolio to make everything work, to pay your bills? That $3,500 would have to be $8,750 30 years later, $8,750. So again, $2,800 sounds great now. Whew, I don't know if that is so great. But the payment is guaranteed. Well, why not just keep your $500,000? In fact, how many years is it going to take for you to get your money back if you're getting $2,800 dripped out to you over time? The answer when you divide that out is 15 years. Or you could keep your $500,000 and just pay yourself the 4% rule and see how it goes. As we talked about, running out of money is your biggest risk to your portfolio. There are a lot of things outside your control that it could cause you to run out of money. Inflation, definitely one of them. Longevity, living a really long time. Premature death or disability while you're working during your peak earning years, and divorce. A lot of times these things are totally out of your control. So the solutions are to control what you can control. You can control your estate planning, making sure you have all of the documents for incapacity and death and that your heirs are protected. You can control term life insurance, making sure that, again, during your working years, that you have enough life insurance were something to happen to you. Long-term disability insurance during your working years. Long-term care insurance, something you should purchase during your working years to be used later in life. And owning stocks. Stocks help mitigate risk. Believe it or not, people think they're risky. No, they fluctuate. That's not risk. Risk is the rising cost of living. It's the postage stamp. That's the risk. Here's an example. We talked about this. $500,000, $2,800 a month. The actual rates that you get are determined by your interest rate, age, and other factors at purchase. And annuity income is taxed at ordinary income tax rate, so I'm not a huge fan of them, although it's only the income. So if you give them $500,000 and it's not in an IRA or anything, it's just a regular annuity, then the earnings on the $500,000 are what's taxable. So even though they're giving you your own money back over 15 years, you'll pay tax on a portion of that payment, every single payment. We talked about giving up the balance to start your monthly payments is called annuitizing. That's an important term that they throw around, so I wanted to make sure you all understood it. And the starting payment for an annuity will be higher than if you had an investment portfolio. It's more than the 4% rule in general, usually, when you start. But the thing is, the annuity payment stays the same forever. And if you die prematurely, it just stops and the money is permanently gone. Versus your investment portfolio, which the prudent thing may be to take out a little bit less in the beginning. But as you move along, there's a crossover point, and it's different for every annuity. It depends on all of the facts and circumstances. And after that crossover point, the investment continues to grow. And when you die, your heirs get your investment, or charity, somebody does, versus the annuity, which the money just goes poof. If the money doesn't go poof, it means you paid for a rider for life insurance. And you could have just bought a life insurance policy for that. And we haven't really talked much about the fees that are inherent in annuities, but there is a substantial amount of fees. And there's, of course, is no lump sum if you buy an annuity. You can't go into your annuity and say, hey, I want to buy a car, I need 40 grand. Hey, I want to give 20 grand to my kid. I need 10,000 to help my vacation. None of that. The money is just gone. I have, if you're going to live to be 102, it may be a good idea. It's possible it can be a good idea. It's not like they can never be a good idea. I just haven't seen it in practice. What's a deferred annuity? Deferred annuity is instead of the single premium immediate one, you give them a premium, a set of money, $500,000, and it sits in an account, and you get a statement for it, and it's invested in some fashion. A fixed annuity means you get a fixed rate on that money. Let's call it $500,000. If it's 5% fixed, you get 5% interest every year on that annuity. On your statement, I don't know if any of you have these, but on your deferred annuity statement, there are usually two numbers. One is a cash surrender value number. That's the real investment. That's the actual money you can touch. And then there's what I like to call the fake account. The fake account is what they use to base your monthly payment that you're going to get in the future. But you can't touch that account. You can't ever spend it. You can't withdraw from it. From an annuity, you can take out usually 10% of the value in any 1 year if you wanted to. That comes out of the cash surrender value. That does not come out of the fake account. Well, they probably reduced the fake account in some way, but the cash surrender value is the real money. The fake account, if you have some rider that increases something 8% a year, it's increasing that fake account, not your real account. Your real account is based on the underlying investments. And when you withdraw from a deferred annuity, you haven't annuitized it now, because once you annuitize it, remember, the payment is static and the money is gone forever. So if you invested in it, you're saying, I'm going to annuitize it at some point in the future. That's why you're buying it. You're paying them an annual fee. It is not uncommon to see 3% in total fees in annuities. Not always. But the underlying, and if you have what's known as a variable annuity, the underlying investments can be stocks and bonds. Now, that can be good because you get tax deferral. If you're at a very high tax rate and you already save everywhere else, it's possible that that can be a good idea. But usually not, and I've never seen one of those be a good idea. And usually the underlying investments, the underlying mutual funds in those things have expense ratios higher than 1%. And I know Dan and Steve here have many, many years of experience working with clients, and they have seen lots of these contracts. And I think they can agree that a lot of these are pretty high. We talked a little bit about fixed versus variable annuities. And it's important to understand that on a fixed annuity, the interest rate is only received until you annuitize it, and then the payment is fixed. Variable annuities can fluctuate based on the underlying investments. So the payment isn't necessarily fixed. It can wiggle somewhat. But generally, because the fees are so high, those aren't really terribly great investments. I would suggest just investing in a regular old taxable account. As we talked about, there's a lot of pros. And the fees can be really low. Indexed annuities. These are great. An indexed annuity is heavily marketed, preys on your fear of volatility. They guarantee you some low interest rate and an ongoing payment, but the upside is capped because they say, great news, it can never earn less than, it'll never drop below, say, a loss of 4%. But it's going to be connected to the S&P 500. So you think you're going to get the S&P 500 returns if it goes up, but your loss is capped at 4%. That sounds amazing, except that they cap the upside at, I don't know what, every contract is different, but let's pretend they cap it at 7%. Well, the majority, not the majority. Probably 30 to 40% of the S&P 500 return is reinvested dividends. Most indexed annuities don't allow for the dividends. So then you've just got a haircut of 30 to 40% off of the S&P 500 returns. And remember what I said, where are most of your returns made? Whoop, whoop, right? So the big, up 22%, down 12. So that's great, they cap your loss at 4, but they're capping your upside. So we were talking before this about an annuity, an indexed annuity that we had inherited that made over a 10-year period. I don't know what the original investment was. Was it $500,000, Steve? Do you remember? Something like that. They put $500,000 in this thing, and over 10 years, they earned $700. Ouch. Ouch. So these are so bad that the SEC has put out, and we've linked it here, an investor warning. And like I said, you can get the slides by downloading the QR code, which is probably in your packets and earlier, if you want to click on any of these links. These are terrible. Read the contract before you buy one of these. The problem is nobody reads these things. Okay, well, you really need to know what you're getting. I can certainly say for me, I have never met anyone who understood this product and what they were giving up when they bought it. There are uses of annuities. As I mentioned, extreme savers in the highest tax bracket. Somebody who is really, really afraid and can't sleep at night without that, knowing that they're getting some fixed amount for the rest of their life. I would still want to make sure they understand what they're giving up and what that actually means, because I don't think most people do. And if you're going to buy an annuity, make sure you review the contract carefully for the fees and limitations and understand the tax consequences. Also, it's important to know there are there are very large commissions on annuities when they're sold. Somebody's making a lot of money, which is why they're so expensive to get out of, because they usually have 7 to 15 year surrender charges, which means if you want to get out, you have to pay some 6-7% of the value of the money you put in just to get out. At Milestone, we like to say, look, if you're unhappy, you can leave anytime. We don't like locked-in contracts. We don't like fees to get out of things. If that investment is so good, then why do they charge you to get out of it? In most cases, more wealth is built from investing. Wealth is built from stocks. It's not built from bonds. It's not built from CDs. It is not built from annuities. Pensions. Pensions are a kind of annuity. There are either private company pensions or government pensions. Private companies, many offer these days, many of these pensions are frozen. Many companies are offering lump sum buyouts. Whether or not this is a good idea, you should really do something called a net present value calculation, something that our investment advisors at Milestone do all the time for clients to see if it's a good idea. And it really depends how long you're going to live. If you're going to live 10 years, it's probably not a great idea to take the pension. You should take the buyout. If you're going to live 50 years, well, maybe the pension would have been a better idea. But at least you can understand what your options are, how much money you would receive under either option, under different scenarios, and what your choices are. Make an informed decision. Don't just make a decision. Government pensions, however, often come with inflation protection. So remember, annuities usually are the same forever, but government pensions go up by inflation, usually not total inflation. Sometimes, like New Hampshire, goes up maybe 1%, 1.5%. But Massachusetts, I think, is a little bit better, goes up a little bit more. In different states, every state is different. But what's great about the Massachusetts Teachers Retirement Fund, we have any Mass teachers here? What's great about the Mass Teachers Fund? What's the best thing about that pension? No, second best thing. Second best thing. The health insurance. Oh, yeah. It comes with subsidized health insurance because medical costs are really high in retirement. But the fact that a pension that comes with health insurance, or it's not 100% paid for, of course, but it is heavily subsidized, and that can make the pension perfect. I had teachers that just went back and they just substituted for 20 years after their kids, when their kids were little, just so they could get the pension. They only made like enough money to pay for their health insurance, but they're getting this pension now and subsidized health insurance for them and their spouse for life. So that there are some government pensions that can be a good deal. And pensions are taxed at ordinary income tax rates as well. So pros and cons to pensions, kind of like same. If the pension comes with health insurance, then it's a pro, huge pro. It is guaranteed income, but the cons are the payment amount never increases, taxable at ordinary income tax rates, and no lump sum to draw on or leave to heirs. Everybody's favorite. You all came for this one, right? Social Security. Social Security is actually an annuity. It's a form of a pension, but it's inflation adjusted, so we like it. In fact, you cannot buy this kind of annuity because Social Security will increase approximately your benefit, the monthly payment that you get, the benefit will increase approximately 8% for every year you wait to collect. So most people collect at age 62, which is the earliest most people can collect. And they collect at 62 usually because of either misinformation, because they were uninformed, or because they need the cash flow. There is a big misconception that the year you retire is the year you collect Social Security. They are not related. The year you retire, now you may have to collect Social Security the year you retire if you don't have any other income. That is certainly possible. But that is not necessarily advised because then you don't get that 8% bump up for every year you wait. We strongly suggest for those folks who have good health, it generally makes sense to wait until you're 70 to collect. That can be especially important if there's two of you and there's a high earner, low earner, lifetime earner in the household. We'll talk about that in a minute. We have to talk about the concept of full retirement age now because Social Security payments are based on this. FRA. Full retirement age, for those of you that were born between 1955 and 60, is age 66 in a few months. You probably all know this. You all get your Social Security statements, and it tells you what your full retirement age is. Full retirement age for anyone born after in 1960 or later is age 67. Now, if you expect to live into your 90s, past 85, we generally advise waiting until age 70 to collect. For all the reasons I mentioned, 8% a year that you wait. But if you're in poor health or God forbid, you get a diagnosis that you think might result in your death, that's when you file right then. Also, if you have minor children. Some folks, especially second marriages, there might be minor children or you might have custody of a grandchild or whatnot. That minor child can receive Social Security payments up to age 18. And if you wait till 70, they might age out of that. So that can be a reason to file Social Security earlier than 70. There are literally thousands of different possible claiming strategies. So you really can't identify what yours is going to be based on this or any other seminar. You have to talk to somebody or do some research and look into your very specific circumstances. Because if you were divorced, let's say you were divorced hypothetically, if you were married to your spouse for over 10 years, you can collect Social Security on their Social Security. You get to collect 50% of their benefit based on their full retirement age benefit, no matter when they collected. So if somebody's full retirement age benefit, you know what, we're going to go right into the next slide, actually, which has an example. But before we do that, I just want to point out that if you collect before full retirement age and you're still working, if you earn more than about $22,000 a year, Social Security can claw back the Social Security income. So in general, if you're still working, you want to wait till full retirement age, unless you're making less than $22,000 a year. Here's our example. We've got Jane and Jim. Jane works, earns $200,000. Jim was a stay-at-home dad, and the kids went off, and he runs the house, so Jane can work. Jane was born after 1960, so her full retirement age is 67. Her full retirement age benefit is $3,000 per month, and she collects at age 70. So therefore, her benefit that she collects is $3,780. But Jim, his benefit is based on her FRA, her full retirement age benefit of $3,000. Therefore, his benefit is $1,500 until she dies. She predeceases him, then his benefit goes up to the $3,780 she was collecting. This is why If the higher earning spouse, it may make sense for them to wait till age 70 to collect extra life insurance because it's an extra large benefit. Because when one person dies, their Social Security goes poof. So you're still net loss of income, but it's just how much lost income. And so what happens is her $1,500 goes up to $3,780. Reiterating, when you claim has nothing to do with when you retire, tell that to everybody you see. Most people get that confused. They think they're related. They are not. And if you defer, it gives us lots more time to implement lifetime tax strategies. Because again, we want to minimize your lifetime taxes, not necessarily in any one year, but over your life overall. And you can do that with partial Roth conversions. Partial Roth conversions is when we just give you income because we do a tax projection and we say, okay, over the next 5 years, your income is going to be lower in these 3 years, and then these next 2, you're 70, so you're definitely collecting Social Security. So in these 3, we want to give you this extra income, and we're going to reduce your IRA balance to reduce the future tax bomb, because remember, RMD's in your future once you're 73 or 75. But that results in paying extra taxes this year. And sometimes that's a lot of money. Clients are like, what do you mean I'm paying $5,000 a quarter estimated tax payment? Well, we're doing Roth conversions for you. It's a good strategy because it's going to reduce your overall lifetime taxes. Your lifestyle, health, life expectancy, all of that influences when you collect Social Security, but not the date you retire. We talked about all of these things. Whose record you should claim? Should you claim yours, your current husband, your ex-husband, your ex-wife, whatever? Depends on the situation. What if the returns are really bad the first few years of retirement? Bummer, you retired into a dip. Well, again, if you worked an extra couple of years, you saved diligently, you can retire with more than you need. It renders the market movements irrelevant. That's the easiest thing, not the easiest thing, but that's mathematically the easiest thing to do, not the easiest thing to do in practice. There are other strategies such as this. None of them are fantastic. You just can't control the markets, but you do have to remember that because of the market volatility, that's why stocks have the outsized returns. That's why stocks build wealth. Asset allocation, we touched on this briefly before when we talked about the bucket approach. The percentage of your portfolio allocated to stocks versus bonds is your asset allocation. Here's the bucket again. The asset allocation impacts your withdrawal rate. Historically, the more you have in stocks, the better your long-term returns. This is true historically in every long-term time period ever. When we look at our clients' portfolios, oh look, there's the 80-20 portfolios, 80% stocks, those are the ones with the highest long-term returns. There's the 70-30, and it just keeps going down mathematically. It's just like you can graph it. It's the way it is. Past performance does not predict future performance. There are no guarantees with investments, but this is just the way it's been. Your asset allocation, whether you're 80-20, 70-30, 60-40, that should be based on your distribution needs, how much you need to withdraw from the portfolio. It should not be based on your age. You should not say, none of this 100 minus your age. Don't do that. That's rules of thumb can be very dangerous. And this is one example of such. There are many variables that factor in your ability to retire without running out of money. How much is in your investment portfolio? What is your spending? How much do you need? Do you want to leave a legacy to heirs or charity? My retired clients who inherited stock from their parents, they understand risk because they've got the Apple stock that their grandfather bought before he died 10 years ago at, $100 a share. And now there's $2 million capital gain built into that thing that we're sitting on, trying to diversify out. Hey, I sold a few 100,000 more and it's above 2 million again. But it's interesting. It's very interesting because the retired clients that inherited from their grandparents, they inherited individual stocks, and so they're not afraid. They're not afraid of the stock market swings, and they're like, no, we want to be 80-20 because they get it. That's why they inherited this wealth. That's where wealth is made. There are some clients in this room whose parents did that, and that's why they have wealth, the wealth that they have. Don't be afraid of the stock markets or swings. I know I'm killing that point. It's really important. If you need to spend a good 5% of your portfolio, if you look at what you need to take off your portfolio and it's at least 5% of it, you are going to need a good slug of bonds and fixed income and cash. You're going to need about 30% to fund that because you need to withstand the 2 to 3 year downturn. So I wouldn't necessarily be more aggressive than 70-30 on that sort of a situation. But if you're only spending 2%, you could certainly be 80-20 pretty safely. Obviously, it depends on your individual needs. Don't take personal advice. Caveat, caveat, caveat. You can become rich from a single stock in that Apple example, but you don't generally stay rich because companies that were fantastic 50 years ago are totally gone now, right? They were the Nifty 50 or whatever they called them. I don't know. There's lots of great companies back. Xerox, a lot of people made money in Xerox. Polaroid, Kmart, I don't know. There's many that are not smart. Lehman Brothers, anyone? Enron, how about that one? Okay, you want to diversify. Diversification is how you keep your wealth. Magic dates. We were talking about this a little bit earlier today. There's lots of them here. The one I want to harp on right now is age 63. This is the age, if you are 63, that your Medicare premiums are affected. Because your Medicare kicks in at age 65, and it's based on your income at age 63. So a lot of people don't understand that. And you might say, well, who cares? I'm just going to pay whatever the Medicare rate is. What is it, $175 a month for health insurance? That's great. I can't wait to pay that. Well, that's if you're not higher income. We'll talk about that in just a second. More magic dates here. As we talked about, age 70 last year to get your full Social Security increases. Don't wait past age 70 to collect Social Security. There's no benefit. You want to definitely collect at 70. We're going to go through an example of whether or not you can afford to retire. Now, many of these topics and slides, we actually just recently wrote a blog on. There's a bunch of blogs linked at the end of the slides, and you can also get them on our website. But we wrote a blog specifically on can you afford to retire. But here's an example. Say you've got a 401k balance, and it's got $1.5 million. You haven't yet worked with your advisor who's told you to roll that thing to an IRA, so it's still in the 401k. You can take 4%. You say, I want to take 4% off that. That's 60 grand. Now you also are over 70, let's say, so you've got $3,000 a month for the working spouse in Social Security and $1,500 a month for the non-working spouse. You're paying $13,000 a year in income taxes. Can they retire? I don't know. What are your expenses? It's all about the expenses. What is your spending? Now, you're not paying FICA or Medicare taxes anymore because you stopped working, so that's a boon. But you might be paying more in health insurance. Unknown. So you've got your $60,000 plus your $54,000 in Social Security minus $13,000 in income taxes is $101,000. That's about $8,400 a month. That's what you're living on. So before you retire, this is something we recently started telling clients to do. If you're getting close to retirement, put all of your paychecks in your savings accounts. Everything. Every last piece of income goes right into savings accounts. And then set up an auto transfer for $8,400 into your checking account and see if you can live on it. And remember, that's got to cover everything. You've got to save up from that because your vacations and your real estate taxes and your home improvements and, I don't know, whatever else you have has got to be covered by that. So whatever that number is, do a transfer and see if it's like mini practice retirement. And wouldn't you rather know now than when you're in retirement? Oops! You don't want to find out later. If it's not enough income, there's choices. We talked about these. Not great choices. Much better to retire with more than you need. Second example, this is the tax diversified plan. Same 1.5 million, but it's split up differently. You've only got $1 million in your 401k, and you have 500,000 in Roth IRAs because you've been diligently depositing in your Roth, which you can only do if you're under the income limit. Or maybe you deposited into your Roth 401k during your working lives and you've rolled it into your Roth IRA now that you're retired. Same 4% rule, same 60K, but very different impact on your taxes. Because $500,000 is in a tax-free account, your income taxes are only $5,000. Now, part of the reason they're so low in this specific example is because all the Social Security isn't taxed. Because Social Security is only up to 85% taxable, and it only becomes 85% taxable over a certain income limit. So in this specific situation, same Social Security, same 60K, but less taxes, but they're getting $9,000 a month instead of $8,400. That's pretty good. That's better. Tax diversification is just as important as asset diversification. Third example. This is for easier math. $2 million and 5%, just to make the math easier. $100,000 is your distribution. If you have $2 million, can you live on it? So when someone says to me, can I retire? I'm like, I don't know. What's your spending? What do you need? What do you have for assets? Well, I have $2 million. Okay. How much do you need to live? $100,000? Yeah, maybe. You know, there's a lot of other factors, things to look at, different scenarios. It really depends on your expenses, because are you going to blow that $100,000 because you forgot about next year you have to go to Aunt Sue's wedding, and that's another $5,000? I don't know. But a rough rule of thumb is you need to be able to, if you can limit your distributions in the first year to 5% of your portfolio comfortably, you're probably in pretty good shape. I would suggest always running a tax projection or having one run for you. We do tax projections for all of our clients before we move money or suggest any strategy, because you just don't know. You can think you know that you're going to pay 15% on those capital gains, but when you run it through the projection, oops, that bumped the Social Security up, and I have some self-employment income, and there's this new thing called QCD deduction. Oh, I blew that. Oops. Didn't realize that when I said just do 15%. Too many variables. Way too many variables. Even we will not eyeball things. We will run it through the software, run it through the tax projection. Also, if you have too conservative a portfolio, if you're allocated 50-50, 50% stocks, 50% bonds, do not expect to be able to take 5% out of your beginning balance and not run out of money. Okay, too many bonds can hurt you. Too many bonds, fixed income. Again, the risk is running out of money in retirement due to the rising cost of living. It is not the fluctuations, the daily fluctuations. Which account should you draw from first? Well, in many cases, you want to take from your taxable accounts first, then your IRAs, then your tax-free accounts, leaving the tax-free accounts to compound, right? So we like them to grow because they grow tax-free. However, realistically, you want to spread your taxes over your lifetime. So you might be taking primarily out of your taxable accounts, but then you're slowly working in some IRA Roth conversions, moving those to Roths along the way so that you don't have that giant tax bomb later on in life. Relying on any rules of thumb can be detrimental to your finances, so be careful doing that. Even rules of thumb that I'm spouting here, you know, it has to be very highly customized to your specific situation. But a low tax bracket is a terrible thing to waste. Don't incur zero taxes and think yay, that's not good. You want to, especially if you have an IRA. If you have an IRA, that's really not good. Also, do you have heirs? Who's in the higher tax bracket, you or your kids? If you have more money than you need, and we're not talking about gifting, but there can be gifting strategies that you can do that help spread the family tax load around. Stuff your Roths full, save and invest your HSAs. Don't use your HSAs for medical expenses. Save them. They grow tax-free. You get a tax deduction for putting into them if you're under 65. Once you're on Medicare, you can't contribute to them anymore. Let them grow until later in retirement. Save, save, save. That's the moral. The more you save, the less you're spending, the less you spend, the less your required spending will be in retirement. Let's talk health insurance, everybody's favorite topic. If you're under age 65, and you want to retire, because you want to retire early, right? But health insurance is going to hold you up because you've heard these horrible things. Well, let's talk about what that actually means. You're not eligible for Medicare until 65. You know that your income at 63 determines your age 65 Medicare premiums. But what are you doing for health insurance in the interim? Well, you're probably going to go on an exchange health plan. Exchange health plans are pretty terrible in New Hampshire. Massachusetts are marginally better. Mass has better rules when it comes to this. If your income is greater than 400% of the poverty level, then you can qualify. Your premiums are capped at 8.5% of your income. And if your income is less than 400% of the poverty level, then it varies the amount that you'll pay. The high is 8.5% of your income on down, depending on what the premium is. So we really have to watch income in those years between you retire and 65 when you collect when you sign up for Medicare. The problem is those are also your prime Roth conversion years. So it's tricky. So are you going to pay an extra $10,000 in health premiums, or are you going to be able to do Roth conversions and stave off a future tax bomb? These are hard decisions. We do a lot of complicated calculations to figure out the pros and the cons and then present it to the client and let them choose. It's a little bit tricky. Good news is through the end of 2025, as long as you made a good faith effort to estimate your income when you signed up for an exchange health plan and said, my income is going to be, say, $60,000 this year. And so they give you an advanced subsidy. And even though the health insurance costs $800 a month per person, they say you only have to pay $500. The government's paying a $300 a month subsidy, and they reconcile that on the tax return. But it's not a tax subsidy. But it pays in like a tax. So if you owe taxes at the end of that tax year, it is because they make you reconcile it on the tax return. And it looks like a tax, unfortunately. Not fun calls when we have to call people, oh, you owe $5,000 because your income was actually higher than we thought it would be because of whatever. And you don't always control this, because if you own investments in a taxable account, mutual funds throw off capital gain distributions and dividends, and you don't necessarily control it. Last year, there were hardly any because the year was so bad for stocks. But in years before, they've been pretty big. So that can blow you right out of the water, too, in terms of your subsidy. But through 2025, you don't have to repay the subsidy as long as you, in good faith, estimated your income. These are really tiny numbers. I can't even read those. This is the 400% of poverty level, and I will try to read you some of these. It is for a family size of 1, 400% of poverty level is about $60,000, and for a married couple of 2, it's $81,760. So if your income is less than that, then you can start to get a larger subsidy. And if your income is more than that, the health insurance premiums will be capped to 8.5% of your income. But that rule expires at the end of 2025, unless it's extended. Medicare. Now you're 65. Woohoo, made it to Medicare age. You enroll in Medicare. You can no longer contribute to your HSA. You may not enroll in Medicare if you're still working. It depends on your employer situation. But on the simplest situation where you're retired, you enroll in Medicare. This is a huge alphabet soup. We have Medicare Part A, Medicare Part B, C, and D. And then within Part B, we have plans A through N. It gets very complex. Okay. What I want you to remember, Medicare does not cover vision, dental, hearing aids, or glasses. It's really just medical expenses and prescriptions at this point in time. Part D covers prescriptions. Part A is hospital. Part B is medical. All of this, again, every October we put out a blog talking all about this, and we just recently posted a blog about Medicare and what everything meant. So I won't go into that in too much detail, other than to say, please don't buy Part C in general. Part C is Medicare Advantage. It is heavily marketed. The insurance gentleman that we use in New Hampshire has told us that he gets a bigger commission for selling Part C plans because they're HMOs, so it's very efficient for the government. It's very limited. You get to do this. Like if you've all had HMOs probably, you're very limited health coverage. You really want the freedom to be able to go wherever you want, use whatever doctors you want. You want the PPO model. That is a Part B plan combined with a Part D plan. The thing about Medicare Part C, Medicare Advantage, is they'll say, but it's free, or $5 a month. Doesn't that sound awesome? but now you need to use it. So we've had some people have some pretty bad experiences with Medicare Part C, and specifically the insurance guy that I use that sells these plans said, I won't sell anyone a Part C plan because they're terrible. Because the people, what do they complain to? They complain to the guy that sold them the plan. So that was very interesting. Now, Massachusetts plans, for those of you that live in Mass, are different. Massachusetts subsidizes and kicks in additional benefits, so they are not always terrible in Massachusetts. That's why I say you really have to have your specific situation analyzed by somebody. And we do also have a Massachusetts Medicare specialist that we have people talk to when they're making these decisions. Within Part B, when you buy a Plan B Medigap plan, usually that's the plan you pay some premium for, and then you have to also buy a prescription Part D plan. The one that is covering the most things right now, the most comprehensive, is called Plan G. Used to be Plan F, but that got too expensive, so they reduced the benefits, and now it's Plan G. That doesn't apply in Massachusetts either, because Massachusetts has its own rules, and they got rid of the alphabet soup, and they call things something totally different. So it's very specific to Massachusetts. This chart, I refer to this all the time, even in client meetings, because this is the level of surcharge you're going to get for your income when you collect Medicare, when you're on Medicare. Sorry, you're age 65, how much you're going to pay. The premium's going to be about $175 a month per person this year, unless you make more than $103,000 individually or $206,000 married filing joint, and these amounts change every single year. They generally go up with inflation. And you might say, I'm never going to be subject to that. We make way less than $206. I'm married. It's good. We're good. Then I'm going to say, okay, hypothetically, your spouse predeceases you. Your Social Security is, let's call it, $45,000 a year. Your investment income is $40,000 a year. Your required minimum distributions are $55,000 a year, and that is the required minimum distribution at age 75 on an IRA that's $1.3 million. Now, if you've been saving your entire life in a 401k and you roll that thing to an IRA, it's pretty easy to have $1.3 million after a lifetime of maxing it out. So this is not far-fetched. And now that is a total $140,000 of income you've just blown right into the third Medicare bracket, and your premiums are $349 a month, plus whatever the add-on is for Part D, the prescription plan. So, it highly depends on your specific situations. A lot of people can be below these amounts, but then you start adding in Roth conversions, and we look at this as an extra tax. So that extra $150 a month you're going to pay because of this Roth conversion times 12 months, possibly times 2 if you're married, is whatever that number is divided by the Roth conversion. It's an additional tax on that transaction. But something very important to consider. We have a link on our website to a resource called Crunching Numbers, which it's a PDF document that has all of these things that you can all these charts list, tax brackets on it. It's got like 10 pages of different things, including the Medicare charts, if you're so interested or love numbers like we do. It's on our website. All right, we talked about Part C. Not a fan. Limited coverage. Overall, your rate of saving is far more important than your rate of return. Tell your adult children this. Tell every young person you know. It's more important to save than it is to worry about your extra rate of return on whatever. Save. Aggressively. And again, as I mentioned, the less you spend now, the less you're going to need in retirement spending, and the more flexibility you're going to have. What if you want to retire early, like really early? Well, that's great. There's just more uncertainty. You don't know what life's going to throw at you, and you don't get to control things. Disability, death, divorce, the 3 Ds. Economic crisis, pandemic. If you quit earlier than you have to, you may have shot yourself in the foot. Maybe not. Depends how much you've got, how much you're going to spend. But you might just want to quit the job that you hate and get something else that is a little more meaningful for you. Contentment is an important characteristic of people that are successful with money, and that's because they think long and hard about the purchases they make. The frugal people win. Frugal people tend to be millionaires. Millionaires next door. We see it all the time. The majority of my client base, they were frugal to the extreme. And their parents were frugal and then passed it down to future generations. And now we're teaching the next generations how to deal with money, because the people that made the money grew up with nothing. And so now it's a totally different way of thinking now that you have money. And do you want to keep the money in the family for generations to come? Because, and you probably know this, but most wealth is spent by the third generation. So one of the big ways I like to work with my clients is to help them pass that wealth to next generations, and how do you educate those next generations on what that means? Because they didn't have to earn the wealth, right? So it's difficult, and you want to do everything for your kids, but you shouldn't. That's a whole other conversation. So I've had a lot of clients retire successfully in the past 20 years. No one's run out of money yet. That's good. But they did this by saving diligently, being frugal, and owning a lot of stocks. And they stayed within the guidelines that we present. Now at every client meeting, almost every client meeting, we present here's what your withdrawal rate is, so people can see, how much they're taking out of their portfolio. And I tell them not to panic. Sometimes the markets are going to fall substantially, and your withdrawal rate might be high. It might be 6% because the denominator got really small. But that will usually recover, and we're not going to worry about that because we know we're in a dip. We know it's 2022 and the market stunk, so we're not going to worry about that. Things are going to recover. Let's talk again in 6 months. Calculation of when you can retire is very complicated, as this whole presentation has explained. Based it on inflation rates, rates of return, risk tolerance, asset allocation, expected spending today and in the future, which changes. One-time expenses, tax rates, how they affect you, when do you collect Social Security, what's your Medicare look like? A qualified financial advisor should be able to run all these calculations through interactive software that gives you some answers and clarity. These are our advisors. 4 of them are in this room today, the first four on this slide. If you want to talk to any of them, feel free to wander over and chat with Steve, Kyle, Dan, or myself. We also have a sign-up sheet, I believe. Are there any questions? Anyone want to ask anything?
Social Security question.
Go.
Social Security, Mr. Matt, the trust fund back 10, 15 years.
Yep.
Any thoughts?
Absolutely thoughts.
Can you share this?
I have thoughts on everything financial. So that is very unlikely to affect you. Anybody who's already over 50, you do not need to worry about that trust fund thing running out because they're not going to cut your benefits. Do you know they would be out of office so fast? They want to get elected, okay? So what's going to happen is what happened last time. So the last time this was changed, I want to say it was the 80s because I was, I think, in my 30s, and they said, yeah, anybody under 50, you're toast. We're raising the retirement age a couple of years. But it only applied to us younger folks. But now I'm in because I'm over 50. I am good and not worried about it anymore. You really don't need to worry if you're over 50. It's the younger folks. Sorry, Evan, Garrett, Catherine. You guys will be paying for our Social Security. But whatever they do, they're most likely to make some change that fixes this problem. I would guess they're going to get rid of the cap, or at least increase means test it, so that Social Security continues being paid above $170,000 of income-ish. There's other things that they can do. They can increase the rate a little bit, so that it's not going to happen until the politicians feel they absolutely have to do it. But I don't think you have to worry. Any other questions? And
What year did they institute Roth?
oh boy,
I started at age
yeah,
88
after that.
in 1984, and I know we told about Roth.
No,
So
I don't know the answer to that. Does anyone know the answer to that? 90s. I want to say it was the 90s. Yes, I think that's right.
can you convert to a Roth forever? Like
Yes.
when you forever?
You could forever.
Okay, so it doesn't stop at retirement, it doesn't stop at when you take Social
Nope.
Security,
Nope, but the reason that we stop generally, and we do it only up to a point, is because if you wait till past 70, now you've got Social Security income and you have less room in your tax projection. If you wait till you're 75, now you've got Social Security and RMDs. So it makes it less palatable and way more expensive from a tax perspective. Better to do it earlier. Future topics. These are all our blogs that we have. If there's any other questions, we'll be mingling around afterwards, and thank you all so much for coming. I really appreciate it.